Welcome back to Small Caps, ladies and gentlemen. My name is Kerry Stevenson, and I'm talking again with Mike Haynes. He's the Managing Director and CEO of New World Resources. The ASX code is NWC. Apparently last time, Mike, I said AWC, and someone picked up on it. So no, ladies and gentlemen, it's NWC. So that was a bit of fun. The scoping study that has been done gave you after a pre-tax NPV of about 750 million and indicated it could generate 2.8 billion in revenue over 10 years, which is a nice numbers. A PFS is going to be due in the third quarter of next year, as well as an updated scoping study. So it's some really interesting time to chat to you, Mike. Welcome back to Small Caps. Good to see you.
Great to be back. Thanks very much for having me on again, Kerry.
Well, let's talk drilling, because our community out there always likes to know. And let me just say, to start with, if people haven't realized who you are, this is a copper project in Arizona in the United States. And for those of you that think, oh, Arizona is actually one of the best places to be in the US, very mining friendly jurisdiction. And what Mike's got his hands on is a really decent copper deposit, which is just getting bigger. So, Mike, give us a bit of an update. What have you been doing since I last spoke to you in the middle of this year?
Yeah, Kerry, firstly, if I could just touch on that aspect of mining copper in Arizona, then 70% of the US's copper is actually produced in Arizona. So it is actually an extremely pro-mining jurisdiction. So it's highly favourable for getting our Antler project into production relatively quickly, and we are pushing Antler to production as quickly as we possibly can. But equally, as we do so, then Antler just gets on better and better, getting better and better. And I probably said that to you last time we spoke, where Antler is a rarity, where most exploration projects, as you go deeper and deeper into them, they get harder and harder and more challenging, and eventually in many cases, you find that things are so hard it's not viable to mine. Whereas we're doing exactly the opposite. So since we last spoke, we've continued to drill, and we've announced an updated resource. So late in November, we updated the resource at the project, and it's grown by 48% in terms of tonnes. So we've incorporated our initial resource, which was almost 12 months old, so November 2021. Our initial resource had 75 of our holes in it, our drill holes. We've completed another 48 holes deeper and deeper in the system, increased the resource base by 48%, and the resource now sits at 11.4 million tonnes at an extraordinarily high grade of 4.1% copper equivalent. One of the very highest grade copper deposits in the world. So we continue to have considerable success with the exploration. With our exploration drilling.
I think it's important to point out, because you said 4.1% copper equivalent, just explain what that means, because some people will say, well, it's not copper, straight copper, it's copper equivalent. So just explain what else you've got there.
Okay, the Antler deposit is what's called a VMS, a volcanogenic massive sulfide. And VMS deposits are almost always polymetallic. So there's almost always several elements that you can realise financial return from. In our case, we have a combination of copper, and so predominantly most of the value of our deposit lies in the copper. Mm-hmm. But we also have considerable levels of or quantities of zinc in our deposit. Mm-hmm. We also have lead, gold, and silver. And we will be paid for all 5 of those metals. In fact, we will produce 3 different products. We will produce a copper-gold concentrate, we will produce a zinc concentrate, and we will produce a lead-silver concentrate, and sell all 3 of those products separately. But we will be paid for all of those metals that make up the deposit, the economic parts of the deposit.
Sorry, go ahead.
So when we refer to copper equivalent, it's really a simple way of taking copper is the most valuable element in our deposit. So what we do is we determine what the comparable value of the zinc is, what the comparable value of the lead is, what the comparable value of the silver and the gold is. And we add all them together to come up with a copper equivalent number. So in our case, our copper deposit, our 11.4 million tonne copper deposit, grades 2.1% copper, but it also has 5% zinc and almost 1% lead. So when we combine all that together and account for metallurgical recoveries, then we come up with 11.4 million tonnes at 4.1% copper equivalent.
Okay, which is interesting. Does it make it more difficult to process? You said copper gold concentrate, a zinc concentrate, and then whatever the last one was. Can never remember things in threes. Does it make it more difficult to process?
It's typical for VMSs. So okay. It is a little more complicated than just if you had copper only. But there are multiple VMS deposits around the world. Most of your audience would be familiar with Samfire's De Grassa deposit. That is one of the better known VMS deposits in Australia. 29 Metals have been mining the Golden Grove VMS deposit for many years. So those deposits are all using very, very similar processing flow sheets to that we propose. It is a standard practice. But yes, it is a little bit more complicated than if you've got a copper-only deposit. And the key with processing for us is to maximise payability. It's not to maximise recovery of copper. So we could get, for example, 96% recoveries of copper, but that may come at the expense of only getting 65% of the zinc. So rather than doing that, we can actually get paid more if we have high 80% copper recoveries and high 80% zinc recoveries. And ultimately, that ends up with us getting paid more for the contained elements in the deposit than we would get paid if we were just maximising copper recoveries.
Thanks for that explanation. And I think it's also important to mention that VMS deposits are not in isolation, are they? And I think from what I understand, right now you're focused on one VMS deposit, but there could be multiple. Is that right?
Yeah, so for the last 3 years, or not quite 3 years, we have been drilling just a single deposit. So we've been drilling underneath Antler, and to date, we've only drilled over 600 metres of strike, and we've just been going deeper and deeper and deeper, and we've been getting better and better and better results. For example, the deepest hole on the project has intersected 21 metres at 5.3% copper equivalent. The deepest hole in an adjoining parallel thick high-grade chute has intersected 10.7 metres at 13.7% copper equivalent. So extremely thick, exceptionally high grades. And they are the deepest holes that we've got on our deposit to date. And so deliberately, because the grades and the thicknesses have been getting better and better as we go deeper and deeper, we've continued to drill deeper and deeper. Now, we do continue to drill deeper and deeper, but we'll reach a point where we're now down 850, 900 metres below surface, and we know we'll find more ore there. We'll reach a point, though, that we may not be able to mine that ore until year 7 or year 8 or year 9 of the mine life. Okay. Whereas a long strike from us, we have a number of lookalike targets. So when I say lookalike, they have very strong surface soil geochemistry, particularly copper anomalism. And over the last couple of months, we've completed geophysical surveying, IP surveying, and they have identical IP signatures to that over the Antler deposit itself. And these targets, which are within 6 kilometres of the Antler deposit, these targets are yet to be drilled. And we have 3 very, very strong targets that look just like Antler, that we are just in January, February, we will start drilling them.
Okay.
And they will be the first drill holes that we've drilled outside of the Antler deposit itself. And we see that there is, look, it's an unknown quantity at present. As we drill deeper and deeper under Antler, we're extremely confident we'll hit more mineralisation. These are a little bit higher risk, but equally, if we find another Antler or another 2 Antlers or another 3 Antlers, then all of a sudden, instead of having 11.4 million tonnes here in this immediate district, we may have 15, 20, maybe 30 million tonnes now. It's highly
a little premature, but I get what you're saying.
But there is plenty of upside by drill testing these lookalike targets along strike, and they could all be processed through the same processing plant.
When just to mention on the Antler project, that was actually in production back in the 70s, wasn't it? So they were mining back then.
Was most recently mined in 1970, so 52 years ago, almost 53 years ago now. It's a long time ago, and there's still a head frame still standing there, and it was clearly a mining operation, but it was a very small scale mining operation. So they only mined between 1915 and 1970. They only mined 70,000 tonnes of ore from Antler. To put in perspective, we're now defined 11.4 million tonnes. So we've dramatically changed the scale of the deposit, and hence we're looking at a completely different scale of mining operation, which means a much cheaper mining operation. And look, fortunately, slightly better copper price environment. Back when they were mining Antler last time, and then copper price was 45 cents a pound, compared with today, $3.80, $3.90 a pound. But the bottom line is, given the size of the deposit that we've now defined, we actually don't need a high copper price environment to make money. Indeed, the value of the co-products, the value of the zinc, the value of the lead, the value of the gold and the silver, actually more than pay for mining the copper at Antler.
Oh, wow.
So if we think of mining Antler solely as a copper deposit, we actually have negative cash costs. We're anticipating negative cash costs of negative 31 cents a pound against the prevailing copper price of $3.80 a pound. So we're actually making, even though copper price is only $3.80 a pound, we're actually making $4.10 a pound on each pound of copper that we produce. And that's because of the value of the co-products that we've got.
Okay.
So we don't need $3.80. We make very good money at $2 a pound, 6,006.
Yeah, so it's I get what you're saying. It's one pays off the other. I get that. But one of the things that I picked up on a moment ago was you said you want to get into production, but isn't it very early days? You've only done a long strike, I think it was 600 meters, you said. This is a bigger project than that. What are your plans for getting into production? I mean, it's a long way away, I would have thought.
No, so we've done, and the reason we declared a resource a year ago was so that we could do mine designs, because we need that mine design to determine what the environmental and social impact of our mining operation is going to be to apply for mine permits. We are going to constrain all of our disturbances to privately owned land, so that really streamlines permitting. But we still need to demonstrate to the regulators that we are not going to contaminate adjoining lands, and to demonstrate that we're doing things to best practice, so that we can minimise whatever disturbances we've got. So we've been advancing the mine permitting process by doing the initial mine designs. We are about to update that because we now have a much larger resource, a 48% larger resource. So we see that with very, very similar infrastructure, so still with a single decline, still with the single processing plant, we are very confident we will be able to mine at a much higher rate, probably at a 30% or thereabouts higher rate, which will further positively impact the economics. And so we need to include that into some updates into our plan of operations and apply for mine permits. And that mine permitting process will take 18, 24 months once we submit it. And through that period, we will be getting ready to commence production as quickly as we practically can. We will be doing whatever we can at surface and whatever we can with initial development of a decline, not processing ore. Processing ore is really the commencement of mining. But if we can start developing a decline, start stockpiling ore, start building the processing plant, then we will be expediting the Antler project to production. And that's what we want to do. We want to capitalise on high copper prices. We make such good money at $3.80 a pound copper, and there's very widespread view that copper price is going to increase from here, not decrease. Our project's not contingent upon that, but the higher the copper price goes, the more money the project makes. And so let's get it into production. It's robust now. It was robust at 7.7 million tonnes. It
Wow.
will be more robust at 11.4 million tonnes. We'll continue to make it bigger, but we want cash flow from the operation to allow us to continue to make it bigger without diluting shareholders any further.
Well, that was two things that were music to our audience's ear, and that was not diluting shareholders and a cash flow coming in. Tick, tick. You said a moment ago about private land and mining permits. Those two can sometimes have a little bit of a clash. Are these private landholders in a positive mindset about the mine going ahead? Have you got any challenges there?
Yeah, so the private landowner is actually us. So we own both the surface rights and the mineral rights. Well, one of our US subsidiaries, one of New World's US subsidiaries, owns the surface rights and the mineral rights that make up the Antler deposit. So we put that in place. We had a 4-year option going back 2.5, 3 years ago. We had a 4-year option to acquire the private mineral rights and private surface rights. After 18 months of exploration, we saw how well Antler was progressing, and we actually exercised that option early. So we've taken 100% ownership of the project. It can never be taken from us, and we are the owners of the private land. Equally, immediately to the south of the project, we have another 4-year option to buy a much larger parcel of private land, and we intend constraining all of our surface disturbances to those private parcels of land. And the owner of those private parcels of land is going to be New World. So that in itself means that we aren't dealing with a third party as the owner of private lands. We are the owner of the private lands.
That is unreal. That's a really great position to be in. Have you got any environmental issues there? You know I was talking to, I won't mention the company name, but I was talking to someone, they recently had a challenge with a particular plant on the land that they had to get through the environmental process. Got any challenges like that, Mike?
We haven't identified any to this point. So we've done a complete environmental baseline analysis of the private lands that we currently own, plus the adjoining lands from which we have been drilling for the past 2.5 years. The area to the south that we've optioned, that's private land, we are in the throes of surveying that. For all intents and purposes, to me anyway, to my untrained eye, it's identical landscape. It's physically a line on a map that is a boundary, but biologically, then it's exactly the same environment as we cross that line. So I don't anticipate that we will come up with anything that is unexpected, but we still need to go through that process. And indeed, because very little grows in Arizona because of the harsh environment, then the optimal time for us to do that baseline environmental work is March and April, when it's coming out of Northern Hemisphere winter and coming into summer. Then if anything's going to be growing and living there then March, April is the best time to do it. And so we have been delayed slightly by needing to survey these particular parcels of land in March and April, but we'll go through that process. But we are, and look, these days, to build a mine, you want to do everything as environmentally consciously and sensitively as you can. And we acknowledge that. Indeed, we have deliberately going to proceed with an underground mine only, no open pit. An open pit would have a much bigger surface impact. And not only that, visual impact, but arguably create a bit more dust and a bit more noise. So deliberately, we are going underground only, even though the economics would be maybe marginally better by having a starter pit. And with the underground only approach, we also anticipate returning around 50% of our waste product, our tailings, back underground as paste fill. So that further reduces the impact that we have on the surface, on the environment. And if we do everything to best practice, as we are proposing by doing these things, then we cannot be denied permits to exploit privately owned mineral rights on privately owned land. So the permitting process is really about ensuring that you are doing everything to best practice and minimizing disturbances and minimizing impact on the surrounds. And we are going to utilize best practice to do so, which will streamline permitting.
Mike, are there other mines close by and around you that are currently mining?
Yeah, really significantly is between 2015 and 2018, a gold deposit about 50, 60 kilometres to the west of us called the Moss Gold Mine. That was taken through permitting, through feasibility studies and into construction, and is now in production as an open pit heap leach gold operation using cyanide. So a lot more environmental impact than our proposed operation, underground only, no cyanide, no open pit. That process was permitted. The permitting of that mine was led, and indeed the economic studies and the construction manager for that mine was a guy called Dr. David Stone. Deliberately, a year and a half ago, we went and recruited David Stone to lead our scoping study, and he's now leading our pre-feas study because he has been through this process before. And he permitted that mine in 18 months, and he readily acknowledges that permitting our operation is even easier than permitting the Moss mine. And we're dealing with exactly the same regulators, the same local office. The local office is located 30 kilometres to the north of us. And the same personnel in that office were the people that he dealt with for Moss Mine, and we deal with the same state regulators that he dealt with. So relatively simple process, but it is still a process that we need to go through.
Absolutely. And fantastic. I didn't know that about Dr. David Stone. Well done, because if he's gone through a gold mine with all the challenges around that, and yours is underground and much simpler, sounds to me like you're underway there. But let's go back to the scoping study and some numbers around that. Let's talk CapEx. Let's talk about how, I know it's further down the track. We're not talking it happening tomorrow, ladies and gentlemen, but what do the numbers look like? And is that going to be debt, equity? In other words, how are you going to fund this?
Okay, I think we've already mentioned that it's going to be a very low cost production profile. So negative cash costs on a copper only basis. In terms of the capital that's required to build that, then our scoping study estimated that it would be around $200 million US, including $36 million US of contingency to develop a single decline with a 1.2 million tonne per annum processing plant that would allow us to develop this mine over an initial 9.5, 10 years mine life, operating at 1 million tonnes per annum. Now, the scoping study indicated that when we reach steady state production at an average of 1 million tonnes per annum, the project generates average annual free cash flow of US $135 million a year, or close on $200 million a year, Aussie dollars, free cash. So that's pre-tax, but it is essentially profits, earnings before, basically EBITDA.
Right. Free
cash. Now, that was on the assumption that we would be mining at an average of 1 million tonnes per annum, based on the resource that was 12 months old, 7.7 million tonnes. We've now increased that resource by 48%. The resource is now 11.4 million tonnes. We are confident that with the single decline, with the same processing plant, which has been designed and costed at 1.2 million tonnes per annum, 20% bigger than the mining rate, we are confident we can use very, very similar infrastructure. So CapEx will remain around $200 million, but be producing at least 20%, maybe as much as 30 or 40% greater rate. So let's just say that we are producing at a 20% greater rate because of the larger resource base. And instead of having free cash flow of $135 million a year, our annual free cash flow is going to go up by $27 million a year. So it'll be closer to 160, 170 US million dollars per year, just by increasing the mining rate by an extra 200,000 tonnes per annum. So that will have a really significant impact on the NPV because we are bringing forward cash flow a lot earlier, paying back capital a lot earlier, And it will also increase the life of the mine, because we now have a much larger resource base. So the project just continues to look better and better, and hence gives us more and more confidence to push this into production and start generating some cash flow, despite the untapped exploration potential that we have both at depth and along strike, where we've got these lookalike targets.
Yeah, I guess that was going to be my question as well, Mike, because it's that balancing act, isn't it? And I really like the fact that, because I think you're a mining engineer by background, aren't you? All right.
No, fortunately, I'm not, Kerry. I'm a geologist and geophysicist, so that's.
I knew I'd get that wrong, ladies and gentlemen. It's Christmas. What can I say? Let me ask you this: chicken and the egg. Do you keep exploring, or you said no? We want to get into production, so we're not going to dilute shareholders, etc., etc. So, is that the sense? I don't know. I'm not a geologist or a mining engineer. Is that purely so that you're not diluting shareholders, or is it simple enough that you say, Kerry, the decline's simple, we know the ore is there, the capex isn't too much, and once we get into production, we've got that revenue, then it allows us to then increase even more the exploration side of it. Do you see where I'm coming from with that?
Yeah, we've for the last 2 years, we've had a two-pronged approach. Two-pronged approach is, while there's clear exploration upside, let's make this deposit bigger and bigger and bigger. That is a huge value driver. The bigger the resource, the more attractive the deposit is to the investment community. Look, I've had, and incorrectly, but I've had very well-educated financial people, even when we declared our maiden resource of 7.7 million tonnes, the grade is phenomenally high, 3.9% copper equivalent. I've had very knowledgeable people in the resources sector, investment community, say to me, "Oh, Mike, you really need 10 million tonnes." So there was this perception that you need a bigger resource, There was no analysis of, well, I should say muted analysis of the extraordinarily high grades. I would argue 7.7 million tonnes at 3.9% copper equivalent is much more valuable than twice the resource. It's much more valuable than 15 million tonnes at 2% copper equivalent. Because you've got to mine less tonnes, and so you might actually make more money per tonne. But notwithstanding that, there is a perception in the investment community that the bigger the resource, the more valuable the deposit is, and I completely concur with that. And while we have clear, considerable exploration upside, we will continue to drill test to make the resource bigger at depth, and to drill test some targets along strike. Because the bigger it is, the more valuable. But equally, we can push the project to production. And in terms of pushing it to production, then we are going through permitting, but we are building a team. And I know you asked, am I a mining engineer? No, I myself am not. But just last week, we appointed a very experienced mining engineer, a guy called Nick Woolrich, who has built 2 underground mines. We've appointed him to the board, and we've deliberately recruited him to bring him on board to help us advance Antler to production. And we will continue to see further changes to not only our board, but also our operational team, as we recruit more and more people who have the expertise in mining, as opposed to the expertise in exploration and permitting. And we are building out our team to concurrently advance Antler back into production.
Mike, we're running out of time. I could talk to you for hours, because this is, I listen to this and I go, he's going to get into production. My question, which has just completely gone out of my head because it's Christmas, ladies and gentlemen, what can I tell you? Mike, why do you think, because I was looking at your share price recently, I think your market cap's about 67 mil, share prices, it hasn't moved very much. Do you think it's the perception of Arizona? Do you think, what are people waiting for? I mean, because I'm listening to what you're saying and I'm going, it seems to me that you're ticking a lot of boxes. Why isn't the market recognizing that this is actually a high-grade, low-cost deposit, which you are motoring towards production with? What do you think is the reason that you haven't been re-rated at this point?
I think it's pervasive around the global investment community. And Glencore came out, I'm not sure if it was last week or the week before, Glencore came out and said there's this disconnect between the clear demand, the increasing demand for copper in the next decade, and the price of the metal and the price of the companies that are producing copper. There's just a disconnect at present between the investment community and the really positive outlook for copper producers. And I think, and I've said this to numerous people over the last couple of weeks, I think the investment community is starting to catch up. So if I look at the Australian copper producers, then BHP has made a bid for Oz Minerals, and that's to secure copper supply.
Yeah.
If we then look at the next tier of copper producers, Sandfire's share price. Sandfire is probably the next biggest producer after BHP and Oz. Sandfire's share price is increasing. 29 Metals, who are in production, their share price is increasing. But then if we go down to the next tier, the emerging producers, companies like us and companies like KGL and PEX and Eagle Mountain, then companies like us who are developing projects but don't yet have cash flow, none of us have yet seen a re-rate. Now, no disrespect to the other companies, I think our asset is better than theirs because we're higher grade and we're in a better jurisdiction and we're closer to production and going to be lower capex and bigger margin. So I think we should take off before all of those guys. But I think it's a matter of time before the investment community is going to actually deliberately target the undervalued copper stories like ours and start investing in that sector, because we are undervalued. If we have a market cap of $70 million Aussie, yet we're talking about making free cash of around 200 million Aussie for a minimum of 9 years and quite likely 12, 15 years, then there's a clear disconnect in valuation there. And the market is a sensible animal. Eventually, the market reprices things according to how they should be repriced, and I'm extremely confident that we will see a reprice. I'm frustrated we haven't yet seen it, but this is why we're talking to you, to make this opportunity, make you and your investor base, your audience, aware of this opportunity.
Yeah, and they're very smart. Our community out there, they're very smart. They go and do their own research, and that's what I was going to say. Do your own research, ladies and gentlemen, but do the numbers as well. And you can get in touch with Mike. Ask him any questions you want. Sorry, Mike, throwing that out there, but I'm sure you don't mind. Listen, we're running out of time, Mike. I really want to ask you. It's the 3 reasons. Last time you tried to sneak in 16, but 3 reasons why people should be sitting up and taking notice of New World right now.
We've just touched on the main one. We're so heavily undervalued. 11.5 million tonne resource, in a position to make the order of $200 million Aussie free cash flow every year for 10 to 12 years. And we've got trading at a market cap of 70 million Aussie dollars. There's a huge disconnect. And coupled with that, grade is king. Mm-hmm. Grade is fundamental. Grade will drive any project through any commodity price cycle. High-grade gold deposits have much bigger margins. High-grade copper deposits have much bigger margins. So we are in one of the highest grade copper deposits in the world, arguably in the top 30 grade copper deposits in the world, and we clearly demonstrate negative cash costs for copper. That's a compelling reason to invest in us if you want exposure to copper. And then I would say, thirdly, jurisdiction. 70% of the US's copper is produced in Arizona. It is a pro-mining jurisdiction. We're on privately owned land, sparsely populated, but very close to really good infrastructure. So that brings down cost of capital and it brings down operating costs. We could not be better positioned to be building a mine in a great jurisdiction at a time when the outlook for copper price is extremely favourable.
Mike Haynes, the Managing Director and CEO of New World Resources. As I said before, the ASX code is NWC. Very exciting times. Let's come back after Christmas and get an update maybe around February and see how you're going. But for now, copper, you know that we're going to need more and more of it. You just don't turn it on. But as Mike explained, they are a near-term producer, great grades, low cost. Mike, thanks for joining me on Small Caps today.
No, it's been a pleasure talking to you again. Thanks, Kerry. Have a very good Christmas.